Hi there, welcome to Kneppy Invest, and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. And we have a busy one for you today. In fact, I did go through all of your comments and questions to add them up. 35. I might have miscounted a few, so it might be between 33 and 37, but 35. And the fortunate thing is a few of these questions and or comments are going to be answered fairly quickly. But yeah, that just means, I think, that you are giving me some really good questions and some really good comments, and I can't decide between them. So typically I want to do about 20 questions, but today, 35. So let's get stuck into it. Go back to Rick Thellion, who is sort of complaining about JB Hi-Fi staff not helping him. Waited out, no staff. I'm not waiting around. Told the security guard at the door they just lost $3,000 sale. Just James Dean also said that's my experience too. Staff too busy talking and laughing. For that reason, I refuse to invest in a retailer who cannot do basic retailing. Then somebody here told me off because they love shopping at JB Hi-Fi. Who told you off? Hope it wasn't me. Now, if it was me, you got the last bit wrong, because I can't remember the last time I bought anything at JB Hi-Fi. It's been many, many years. However, I will go into a JB Hi-Fi just to see how much people are in the store at that point in time. Now, a couple of things I just want to point out here. Now, when I went to the Apple store, this would have been 2 weeks ago today. 2 weeks ago today. I was waiting around for 30 minutes. I don't blame the staff for that. But during that 30 minutes, I was observing how the staff were performing. It was just wanted to see how they were doing, and I'd give them an A grade. I thought they were doing a really good job. I do think they were understaffed. There was a lot of people in the store at that point in time. There was no hanging around, laughing, talking. They were moving from one customer to the next. Even the guy who helped me was helping me and someone else at the same time. Now, the reason why I had to wait 30 minutes is because they did not have enough trained staff to help me, and that was in regards to iMacs. They had a lot of staff in regards to iPhone, but overall, I think the staff there did a really good job. The other thing I want to point out is whenever I go into a store, and this happened to me today when it comes to MacPack, I went to a MacPack. Typically, when I go into a store, I don't want staff annoying me, asking me questions, how I'm going, that sort of thing. If I want to get help, I will tell them. I will tell them I want help. And that is exactly what I did today. So MacPack, I didn't even know this. They have a sale this week. In fact, it's a 4-day sale. A lot of stuff is 50% off, that sort of thing. And there was this sort of this top thing, a nice top that was 50% off, and that had a price tag, $150. I was like, I wanted to know if that price tag of $150 was a sale price or that was a full price. I didn't know, because that's a big difference, $150 or $75. So all I did was, hey, you, come over here, stuff. And he just answered my question just like that. So I typically don't want staff annoying me, bugging me when I walk into a store, because typically I'm just browsing around, just having a look. So I think it's different. Different people want different things. Me personally, I don't want staff bugging me, and if I need help, I will let them know. Okay, so we're all different, and I think that's the most important thing here. We're all different, and hopefully stores all know that we are all different. Rick Thellion gave me some good advice here. You can claim a media room in your tax return. And I thought about that, and I went, I probably could, because I will use my media room on occasion to do videos and that sort of thing. So that's good advice there. Actually, I won't say advice, but it's a good little comment there. Even your Apple Mac this year, yes, that's definitely true. In fact, I do a lot of, as Just James Dean says here, don't forget to claim the work from home deduction. Yeah, I always do that. I claim a lot of stuff because I do a lot of working from home. And even before working from home, I did do a lot of deductions, including a phone. Do a lot of deductions because of your phone, because I'm a shift worker, and a lot of times I get calls from work by my phone because they're short of staff, that sort of thing. So you can do that just with your phone. So thank you for all your good comments, Rick Thellion and Just James Dean. Thank you for reminding me. Sensei 6, see, by the way, I'm going through some of these questions fairly quickly. Sensei 6011 says, Kneppy, why don't you enter the Brisbane Half Marathon? Yep. Margaret Street, Brisbane, or maybe enter the Gold Coast Marathon. So 1st of June or 5th of July. First thing is I won't be in Queensland those dates. I'll be in mid-north coast of New South Wales. The other thing is I'm not really planning on doing any runs this year. The reason I'm doing running right now, increasing my distance, that sort of thing, is I'm building up my stamina, because when I do my hiking trip, I'll be doing hikes every single day. Now, I think I will be able to handle these hikes every single day, because virtually that's what I'm doing right now. I am doing runs and hikes every single day. And over the last 3 days, I've done a 14K run, 7K run, 7K walk. Today I did a 25K run and a 3K walk. And I don't think I'm going to have any trouble. I do enjoy running. Now, one of the reasons why I wouldn't mind doing another, I've done 4 marathons in the past, and I've done plenty of half marathons. Now, one of the reasons why I might not, and I did plan to do a marathon last year, but I got injured. One of the reasons why I might not do another marathon is simply because my last marathon, back in 2017, I ran 3 hours and 18 minutes, which is a really good time. So I would never ever beat that. But I suppose I could try to get close. But at this point in time, running is just a thing I really enjoy right now. It's just a weird thing where I enjoy. And the weirdest thing about it is, if you ask me, prior to 2000, so I started running in 2012. So if you asked me prior to 2012, I would have said running is awful. I hate running. It just switched. It was like that. I just one day, all it took was one day, and I'll give you the story right now, what happened. So I was going to the gym every single day, and I was using the cross trains, I think they call, to improve my fitness, that sort of thing. And one day, this was a 24/7 gym, so you needed a card to get access when there was no staff there. And one day I forgot my card, so I actually drove to the gym. It was 3 kilometers away from where I work, or from where I live. And when I parked there, I went, oh, I forgot my card. I should drive back. And I went, no, just run back. And I ran back 3 kilometers to pick up my card, and then ran 3 kilometers back. And I really enjoyed it. And went, oh, maybe there's something in this running. And that is when I started running. This was in 2012. And I've never gone back to a gym. I do have a home gym, but I just love running. And if you love doing something, why not just keep on doing it, particularly when it comes to something like running? Yeah, and I definitely prefer running over cycling. And one of the reasons is because I'm more of a loner when it comes to sport, and running is such a, I wouldn't say a lonely thing, but it's something where you can just do it yourself. Cycling looks like it's more fun if you got a peloton or something, and I have no interest in doing pelotons. Okay, Stu Percy says, hi, Kneppy. It's time I say thank you for your videos and thoughts on the share market. The biggest lesson you have taught me is basic chart knowledge, especially seeing a downtrend and volume amounts. I'm quicker to sell now when the charts turn down. If I had this knowledge a few years ago, I could reduce some of my big losses. Chasing a falling knife has not been good for me. Cheers, love your work. Oh, thank you very much, Stu Percy. So I think some of your comments are just some ego stroking. My stroking my ego sort of comments, and this is one of them. So thank you very much. And I'll be honest with you, when I started this channel, I had no intentions of doing much with the channel. And one of the things I think I've mentioned in the past, all I need to do is help one person. If I can change how one person invests for the better, it has been worth it for me. And I think I have done that. So thank you for that nice little comment, Stu Percy. VB Ed says, you mentioned that you watch live wire videos. I do also, yes. Well, I actually read a lot of live wire articles, and I listen to the podcast, and on occasion I will watch the video. So I do all three things. They are one of the better YouTube share investing channels. I know you follow the world's biggest bear also, Stephen Van Meter. I really like Stephen Van Meter because of his contrarian viewpoints, or contrarian thoughts or opinions. And when I mean contrarian to my own. So I am bullish overall. I'm fairly bullish, optimistic. And Stephen Van Meter is complete opposite. And I think it's very helpful to get the viewpoint from the opposite side. So, for instance, if I was a staunch Republican, which I'm not, or even a staunch Democrat, which I'm not, it would be very useful to get the other side. But I don't think people do that. I think people stay in their own lane. If you're a staunch Republican, you probably just watch the Republican channels, YouTube channels. I'm trying to think of one. Shapiro, is it one of the guys? I forget his name. He's a Jewish guy with the hat. And if you're a Democrat, you probably just focus on the Democratic YouTube channels and don't really get the other side of the story. So I do like that contrarian, different viewpoint, and Stephen Van Meter is that for me because he's just so bearish. The ultra bear. He is the polar bear of bears because polar bears are the biggest bears. I'm pretty sure they are. What other financial YouTube channels do you watch? Do you follow Peter Switzer, Anything Money? No, I don't. I don't. Peter Switzer, Anything Money? No, I don't. I don't. So I'll be honest with you, I don't watch a lot of financial YouTube channels. Let me just have a look off screen here. I'm just going to have a look. I'm just going to open up YouTube. You can't see this at all. And there's a reason for this, because you obviously see what other sort of stuff like I do watch. For instance, I watch music reaction videos sometimes. The Charismatic Voice, that's really good. But there's not many YouTube videos that are popping up. I mean, financial YouTube videos that are popping up. There will be some, like there's one here from Motley Fool Australia. I don't watch that. That's just popping up because I have no idea why. But I don't really watch those. I do like crime videos as well. I really like crime videos. So EW body cam. Like the other day I watched Fred West and Rose West, a video on Netflix. There was 3 episodes. I watched it back to back to back. I don't know. And the reason I think I like that sort of thing is because I just don't understand how someone could kill other people. I just don't understand it. And I think that's, again, me just being attracted to things that I just don't understand and trying to understand it. I just cannot think. Oh, Hearsay Financial, I sometimes watch that. So Hearsay Financial, Hearsay Financial, I can't even spell. Yeah, I sometimes watch this one. Not all the time. You can see I don't watch every single video. That's the other thing. When I do follow someone, I don't watch every or listen to every single episode. I will pick and choose. So I am picky when it comes to what I will watch. So for instance, why low inflation means more stimulus ahead? That sounds sort of interesting. Who is really winning the US China trade war? Government spending actually shrank this quarter. The Fed is stuck. Get ready for QE. So I will watch some of these. This is what it looks like right before depression. So I will pick and choose what I do watch because my time is precious. My time is precious. American football positions explained. Offense and defense. That's nothing to do with investing. Olympic distance runner attempts for decathlon. Or I also watch like Beard Meets Food. I find this so interesting. Beard, and by the way, he's really charismatic and really good. Beard Meets Food, and he is really popular. 5 million subscribers. He's a, what do you call a competitive eater? And just what he can eat in one sitting is just extraordinary. But I think he's really charismatic. He's just so good. I think he's English. So anyway, but otherwise, I just can't think of anything else I do watch. Yeah. That's it. That's about it. Okay. So sorry, VB Ed. So not much of a help with you there. I can almost guarantee you eventually, and you probably can see that I don't listen to, watch, or read a lot of financial stuff. So it's very limited. Other than that, I watch a lot of other stuff. So financials or the stock market is a very small part of my life, a very small part of my life. You might find it interesting or intriguing how small it is when it comes to my life. Simon PT 2000, Psychology Fact. When a person spends too much time alone, he either loves his loneliness, peacefulness, or feels that no one understands him. And Scott says, or kept in confinement against their will. Perhaps have you read Thus Spoke Zarathustra? and it could offer a fourth dimension. I've heard this. I don't have no idea what it is, but I have heard this one. Yes, anyway, I'm not going to read that. But anyway, is there any such thing as too much time alone if you do enjoy being alone? I love being alone. And do I love loneliness? That's another thing. I would never become lonely. It's an impossibility for me to become lonely. I already know this. It's an impossibility for me to become lonely. Peaceful. I do find it really peaceful. I suppose I enjoy myself. Maybe I enjoy being around myself. I don't have no idea. No one understands me. No, I don't care. Honestly, I don't care if other people understand me or not. That's another reason why I just don't mind being by myself, is because I just don't really care what other people think about me. Just don't care. I don't know if that's a good thing or a bad thing, but I find it interesting when, some people during COVID-19 when people were locked down, some people just could not handle it. But for some other people, they thrived. They thrived in those conditions, and I would be one of those who would thrive being by myself. As I've mentioned before, just spending like a whole year by myself, nothing, not seeing another person, I definitely could handle that. Sensei 6011, thoughts on Aswath Damodaran, saying that the optimal number of stocks to have in one portfolio is 30 to 40. You may have to search. No, I don't. No, I don't. In fact, I on occasion will watch a video from this dude. Here he is, and in fact, I have watched his videos. In fact, there is one video. There is Buy the Dip: The Allure of Dangers of Contrarian Investing. I started watching that about 3 weeks ago. I haven't finished it yet. So I have watched his videos. I'm trying to think, and I'm pretty sure I have a few of his videos. A few of his videos on my to watch list, and it's probably some of these here. Yes, so I do listen to him, watch him, but not religiously. And on occasion, he will pop up on some of my podcasts. Occasionally. The other thing I should mention before I move on is I used to listen to Ausbiz the Call all the time. I no longer listen to Ausbiz the Call because I actually know what most of the experts are going to say about a company. So have a look at the list of companies. I know exactly what the expert's going to say, almost always. And I think I'm not getting as much out of that show as I used to. So that's interesting. Anyway, so I think the main point about this question is the optimal number of stocks to have in one portfolio is 30 to 40. Now, if you ask most experts, they'll say 20 to 30, and I've been told off because I have too many stocks and I'm just getting too much diversity. But I think 20 to 30 is, I suppose, a good range if you only invest in the bigger companies. But I not mostly, but say in American companies, I invest in the big companies, and I have about 10. In fact, I can tell you right now how many I have. So among the big companies in America, or in American companies, I currently have 1, 2, 3, 4, 5, 6, 7, 8, 9. I've got about 13. And I am willing to build that up to about 20. So I do think 20 or 30. But when it comes to like the American or my Australian portfolio, I have way more holdings because a lot of those holdings are really small and small caps. So when it comes to, and the reason why they say 20, 30 is because then you diversify out and you're just going to get the average anyway. So what's the point? But when you mostly invest in small cap companies, you're not really getting the market returns because the small cap companies are a very small portion of the market, if that makes sense. So I'm not a big person. How do you say this? I'm not a follower of can only have 20 to 30 companies in your portfolio. And in fact, if you have a lot of fund managers, they have way more than what they say the normal person should have. In fact, some of them have 100, 200, 300 companies in their portfolios. And the reason they have that many companies is because they're diversified throughout the world. Anyway, so 30 to 40. Yeah, so I can sort of understand 30 to 40. I definitely would prefer 30 to 40 over to 20 to 30. And it also depends on if you're talking about in the one country as well. So right now I have I reckon I have about 75 companies I invested in. In fact, I can tell you right now. If I open my lists, I have 32, 68. Yeah, 68 companies in Australia. And in America, I have, well, internationally, I have another about 25. So way more companies invest in Australia because a lot of those companies are very small and they're also very small holdings. Okay. Rick Thillian says NAB predicted a 50 basis point cut in May. But many don't think that. I think that has changed from 5 days ago because of the news flow we have seen this week. So the two big news things we have seen this week, and I think means that we might see a rate cut this next week, but they believe that we're going to have 50 basis point rate cut in May. I think that is now absolutely gone. And the main two reasons, wage growth, a bit of strength there. And I have no doubt the Reserve Bank sees that and they go, oh, wait. That's actually a sign that inflation could be coming back. And the other one was, the robust labor market, way more jobs added to the market in the last month or so than anticipated, which also points out to a robust labor market. So if you have full employment, a robust labor market, you just think competitive pressures and wages go up, and that definitely will be lead to a possible return to inflation or higher inflation anyway. So I have no doubt the Reserve Bank is looking at that. So I do think there will be a rate cut in May, definitely not 50 basis point, but I do think the belief that there's going to be 5 rate cuts in the next year, I think that's gone. The only way that's going to happen is if we do go into a really bad downturn, a recession, and that's not what we want. So this hope that we're going to see a lot of rate cuts in the next year, I think that's gone now. Unless, of course, we go into a recession. Millsy1704 says, is it a breakout for VRX Silica? Let's have a look. VRX. Not a company I follow too closely, but I do know the TIG code. And for some reason, maybe I just have to refresh. VRX. Oh, hello. Okay. Now, chart-wise, a very, 9th of May, and then the 12th of May, we had the share price rising 27% and then 22.8%. And then the share price the next 4 days sort of went sideways. A couple of down days there, but I do like that price action. Also like the volume coming in, some nice volume coming through over the last week and a bit. We started to see the volume rising back in November. Also a bit of a bump in the rise in volume in January. That's a good sign. So definitely at that point, the downtrend had come to an end. So share price had been in long-term downtrend, looks like. Whoa, geez, this is a long-term downtrend. From 2020, share price gone from 42 cents down to like 2 cents almost. And looks like that downtrend is coming to an end. Now, for me to, just based off technicals, I would say this is a breakout. The share price at 7 cents, we're talking about a year high. Good volume coming through. The only thing that might be missing, well, this is really good. So on my keyboard, I just touch my keyboard, and look at that. Anyway, so the only thing that might be missing for me to classify this as a traditional NEP-defined breakout is a financial announcement. So why has a company gone bananas in the last week and a bit? So on the 6th of May, update on appeals process for Ashmo Smith. They have not released any news. This is on no news. So it could be on the commodity. I have no idea what this company does. They released a presentation on the 7th of May, but the share price wasn't really doing anything at that point. So why has the share price gone bananas with VRX Silica? And I'm trying to think what this company does. I could open up the presentation. I could open up the cash flow report. Let's do that. What is this company, Silica? Okay, so is this one of those, what's it called, the high-grade silica companies? North Silica Sand, so just silica, of course it's in the name. I have no idea what's happening with the silica market. Is the silica market running, is the silica prices running up? I have no idea. I would assume something like that's happening because the share price of this company has just gone not the share price has gone up significantly, but the company has not released any significant information. So that's the one thing holding me back from saying, hey, this is a true breakout. It's just the lack of any sort of news flow from the company. But otherwise, the chart looks spectacular. And sometimes all you have to do is just look at the chart. So something's happening with VRX Silica, and I just don't know what it is at this point in time. You know, I could ChatGPT this. Let's ChatGPT VRX Silica. Why has share price gone on a run? Let's see if this gives us any sort of clue. Why has share price gone on a run? Searching the web. 68% increase over the past month, 100% in the last 3 months, reaching a 52-week high. We've just mentioned that, 7.4 cents. Several factors have contributed to this surge. Environmental approval progress in late April, rising demand in Asia Pacific, strategic equity raising. Well, some of these happened a few months ago. Market momentum and trading activity. The stock's recent performance has outpaced the broader Australian metals. Okay, so there's nothing really in that that leads me to have a strong opinion on why the share price has really taken off for VRX Silica, but it is happening. There's no denying that. Okay, Scott says, even a 10 or 25% tariff will hardly touch the sides of crucial pharma like Telix, which is literally life or death. Insurance pays the bills and the premiums go up, right? No worries. My question would be, did FDA block Telix new product on purpose? Because FDA knows Telix is posting one breakthrough after another from here on to forever, but Telix ain't American. Okay, the reason why I want to discuss this is because I'm sometimes quite cynical. Sometimes I'm very cynical, and sometimes when a company, Australian company, doesn't get FDA approval, I'm in the back of my mind, I'm thinking, well, of course it didn't because they're not American. If they were American, they would have received FDA approval. So this is always running in the back of my mind. I don't think FDA would do that because that would be, well, that would be unethical just because you're approving something or not approving something based off where the company's from. But there's probably other reasons behind it. So I don't want to get too cynical, but these thoughts have flown through my mind on many occasions that sometimes the non-American companies are treated a little bit differently than the American companies. So I can't say this, I haven't thought about this. Can't say I haven't thought about it, but I still think probably not. Probably not. Sensei says, Kneppy, do you have a Gainify account? Funny enough, I do. Funny enough, I do. Wait there, I've also bookmarked it somewhere. Here it is. Here it is. I do have a Gainify. I'm still looking at it, going through it. So I haven't been long on Gainify. Pricing, by the way, one of the reasons I started using this or looking at it was because of the AI, and I did ask Gainify a few questions, and it wasn't as good as ChatGPT, in my opinion. So, and one of the reasons why that is important is because one of the differences between these two pricing structures, like Starter, Investor, and Gainer Pro, is how many times you can access AI. So where is it? AI queries, 10 queries for the free version, 50 queries for the middle version, which is Investor, and 500 queries for the Gainer Pro, which is $26.99 a month, which is, I suppose it's not that much. So over a whole year, that's $300 or so, just about $300, American dollars probably. And yeah, so I'm still going through this, and I don't mind it. I don't mind it. There's a few things in here I really like. For instance, they have dashboard. We go to the dashboard. For instance, calendar. They have a calendar here. So this is for American companies. So who's reporting? when they report, and you can actually filter this by, like Popular, they also have market caps. So you can filter it to only companies with a market cap above $5 billion, or just watch lists, or USA plus market cap $50 billion, or greater than $50 billion. I do like that. And you also have if the results beat or hit expectations. I think that's what that is, and how the share price has performed. So I do like that. They also have what else? What else did I like about this? There was a few other things I did like about it. Anyways, but the main question is, yes, I do have a Gainify account, but I'm a free user, not a subscriber just yet. Still just going through it. Just James Dean has a little bit of advice here, even though he cannot give advice because he's not qualified. Although maybe he is qualified to give advice, and maybe I'm not being fair to Just James Dean. Trade within super and only pay 15% tax. I did not think about that at all. Now, one of the reasons why I'm not trading through super is because of the higher fees, $18 a pop. But maybe because you pay lower tax, that could be, yeah, maybe. Trade under personal account, then pay marginal tax if held less than 12 months. Otherwise, 50% off, still more than super. Yeah, so a really good thought exercise that. So you have given me something to think about, Just James Dean. So thank you very much for that particular comment. Okay. Oh, he also mentioned John's Lyng Group. Share price has dropped $2.34, P 11.8. EPS still has not hit 20 cents. How time has changed, and it has changed for the negative for John's Lyng Group. And one of the main reasons this company has not performed as well over the last few years is because the same reason insurance companies have done really well is because there's been a dearth of natural disasters, which is weird to say. I'm just having a look at John's Lyng Group. Now I'm doing this offline. There's a reason behind this. I'm looking at my super, and I just want to know. I used to own John's Lyng Group. I can't remember if I sold out of it. Now I still hold it. I still hold John's Lyng Group. I wouldn't classify John's Lyng Group as high quality. So it is in my high quality portfolio, but I don't know if I'd consider it high quality just yet, because it is, or the performance of this company is actually influenced by the weather and natural disasters, which is really weird. Anyway, a few years ago, John's Lyng Group had a P/E ratio that was so high. It was going through a really nice growth period. In fact, if you have a look at the revenue growth for John's Lyng Group, about 20% revenue growth over the last 3, 5, and 10 years. So we're seeing a revenue decrease over the last year or so. Earnings per share growth between 15 and 25%. Return on equity 12.9, return on invested capital 14, gross margins 25.9, operating margin 7.8. So I'd like to see the margins up a little bit. Dividend yield 4.7%, payout ratio 51. I'd like to see that a little bit lower, and P/E ratio is fairly nice. But if you have a look at the financials and just have a look at total revenue, you can just see revenue has pulled back. Now, this does include last 12 months. So if we get rid of the last 12 months, yeah, so we have seen a pullback in the revenue in the last year. And the main reason behind that is decrease in natural disasters. And I would assume margins have gone down, but they have not. Gross margins actually increased. Yeah, operating margins have increased as well, but income would have gone down as well. And if you have a look at the P/E ratio of this company, I'm pretty sure a few years ago, the P/E ratio of John's Lyng Group was like 40 or 50. In fact, it was 90. Back in 2022, it was 90. Now, it says 33 here. That's wrong. So it's a little bit lower than that. And back in 2018, it was at this level. So John's Lyng Group does look interesting at these levels. And if we do see an increase in natural disasters, this company will perform pretty good. Earnings per share still has not hit 20 cents. Let's have a look. Let's go back. Where is it? There it is. I'm pretty sure we do have earnings per share in this. And we can get rid of the other metrics. Oh, yeah, it's just below 20 cents. It is rising though. So 20 cents. P/E ratio, yeah, it's just above 10. Don't know where they're getting 33 from. Is that because of the last half year? Let's have a look, the last half year. Oh yeah, there was a significant decrease in the in the earnings the last year or the last half year. That's why that P ratio is a little bit higher. Okay, let's move on to the next question, which is from Fishball. Oh, I've already talked about this, haven't I? Can you please make a video on some of the stocks that you're, in your opinion, turning around? My picks, which have been for the last few weeks, are MVF, Woodside, Satire, Kelsian, CCP, Breville, New Farm, WiseTech, CGF, RPM Global, all which still have more upside. Others which I'm waiting patiently are Cogs, State, IPH, and Fletcher. I probably in tomorrow's technical update video, or today's technical update video, or yesterday's technical update video, depending on when you're watching this video, or last week's technical update video, I might show you some other potential turnarounds. So this is something I'm looking at all the time, potential turnarounds. And I'll probably say some of these companies wouldn't be on that list just yet. I need a little bit more proof. Like Kelsian, I think Kelsian's on that list. New Farm close. Challenges on that list. Anyway, JHBZ69DH says, "Hey Kneppy, could you please explain the super company you use to manage your superannuation? It seems that your super does not have any restrictions, many restrictions on what you trade. Why you choose this company, not any other super company, allows you to trade shares too. Thanks." So this was many, many years ago when I chose Net Wealth. Net Wealth. What's it called? Oh, what is it called again? I always forget what it's called. It's called Super Accelerator, I think. Super Accelerator. I'm pretty sure this is what it's called, Super Accelerator. And this gives you way more flexibility when it comes to your super. So it's not an SMSF, but I am able to trade all the Australian securities. So there are some, like I went from Australian super to Net Wealth because there was some limitations in Australian super. I could only trade or buy ASX 300 companies. I didn't like that at all. So then I went to Net Wealth. They gave you way more flexibility. And the other thing I really liked about Net Wealth is how many exchanges around the world you can trade. Foreign exchanges. And there is quite a few. I'm hoping it gives you a list. Here it is. Here's a list. 15 international exchanges: New York Stock Exchange, NASDAQ, London, Toronto, Paris, Germany, Netherlands, Tokyo, Hong Kong, Switzerland, Belgium, Denmark, Sweden, Singapore, Italy, and Spain. And they also have a list of securities you can buy on all these exchanges. So you can't buy every single company on these exchanges, but you can buy the bigger companies that you have heard of. Like, for instance, in Germany, you can buy if you really, really want to, Commerzbank, which is just like CBA. No, it's not. I have no idea. You can buy Deutsche Post or Deutsche Telekom or Hanover Rourke, whatever that is. Or is Mercedes in this? Yes, Mercedes-Benz is in this. So if you really like Mercedes-Benz, you can buy some Mercedes-Benz shares, or Porsche or SAP. So not as many, or Siemens, Volkswagen, which I do own, by the way. I do own Volkswagen. I also bought, where's Denmark? Also bought some Novo Nordisk via the Denmark exchange. So I just like the flexibility. It opens up your investing possibilities throughout the world. So why Net Wealth over a few others? I can't remember what I researched. The other one I think I might have looked at was Hub24, but I can't remember the differences. I just can't remember. It was too far back in the past. And more than likely, this was many, many years ago. There's more options now, I would assume. I have not looked at this. And if you don't want your super just being invested in a stupid, I don't know what it's, like a high risk or low risk, or you want more control of your super, you can have that control. And I think also, I started doing this when I first started investing as well, and you learn so much. I really liked how I did it. I went Australian super, less flexibility, only ASX 300 companies, that's it. And I started to learn so much. And then I went to Net Wealth. Anyway, so I think I've answered all your questions. Why you choose this company, not any other? Mostly flexibility, but it could have changed, and there's a chance you have more flexibility in other companies as well. Don't listen to Albo says, is the Octopus Kraken software reputedly fast-growing adoption a direct competitor to Gentrack? I have no idea. I have no idea. This would be one of those things you'd have to research. The 30 billion software IPO in plain sight. One is Octopus, the biggest energy retailer in the UK, while the other is Kraken, a cloud software platform used by Australians' origin. I wonder if you could just go like this. Octopus. I wonder if you could just do this. Just put this question, copy, put this into ChatGPT and just see what it says. Because again, I have no idea. Now, I am not a long-term shareholder of Gentrack, but this is something that would be important if there's any or what sort of competition is out there when it comes to Gentrack. Yes, Octopus Energy's Kraken software is a direct competitor to Gentrack, particularly in the utility sector's customer information and billing systems. Anyway. It says Kraken's modern AI-driven platform and rapid adoption by major utilities worldwide have made a significant competitor in the market. There you go. So this could be a threat to Gentrack moving forward. Thank you. Don't listen to Albo for that particular comment because, anyway, even though I'm not a long-term holder of Gentrack, I don't consider it to be high-quality company. This is something this sort of question is really important. What is the competitors out there when it comes to any company and all companies in the world? What is the competition doing? Happynow, I just had to put a Happynow comment in here, I think, because this is not really something I will answer. But what a day, Polynovo, making me super happy with gold going downhill as well. Love it. So Happynow is anti-gold. So what's the opposite of a gold bug? A gold bear? I have no idea. Anyway, opposite. I wonder if you can do that in opposite of a gold bug. I wonder if it answered this one. No, gold. No, I'm not going to go any further. Polynovo. Let's have a look at the chart for Polynovo because this one, I actually did have a look at this the other day. Share price did have a nice little bounce off a support level. And hello, anyone home? Oh, looks like I have to refresh this again. I'm not sure what's happening with a trading view. Oh, yes, so it's had a nice bounce. Oh, that's right. I remember this. This was the bearish engulfing. Yeah, so this had a bearish engulfing on the 14th of May, and I did talk about that. And then down the next 2 days by a little bit. Up a little bit on Friday. So is this the end? Those 2 days are okay. I don't mind those 2 days. So we haven't seen further selling. And also we have seen a decrease in volume. So the sellers are becoming less enthusiastic. And I wouldn't be surprised to see the share price of this company start going up again. So this could be a nice little entry for Polynovo at about $1.49. Even though that was bearish engulfing, I don't see any significant follow-through after that. So thank you for that. Happynow. Sebastian Toll says, do you still hold Telix? I think you should do a video on them alone, considering how much has happened to them in the past few months. Yes, I still own Telix. No reason to even be thinking about selling this just yet. Share price was in a beautiful uptrend. Now the uptrend is looking like it's under threat. So we start seeing higher highs and higher lows. So it's going to be very important to see what happens over the next few weeks. Maybe it's going to go through a period where share price just goes sideways, and maybe we're just waiting for the next positive news flow from the company. So still hold Telix Pharmaceuticals and haven't thought about selling just yet. In fact, I'm probably a long way from even thinking about selling Telix Pharmaceuticals. Will I do a standalone video on Telix? I suppose I could do that. over the next few months. It's not on the to-do list just yet, but I could do it. Okay, Fishball says, can you address any particular light bulb moments or any change in how you find quality stocks or any change in view of the stock market in the investing career? For me, back in the days, I invest only looking at charts. Now, with more knowledge, I always go with the screen at first, then look at the chart, shares outstanding growth margin. Another one is I have 3 portfolios, high quality stocks, which I won't touch unless the model changes. That's like me. Commodity cycle right now is oil, Woodside. It was gold for last year also, but I converted all the Woodside in the last 2 weeks. Stocks which I can see I can make 50% within 1, 2, 3 years. So I have that first bit. I think I always want to have high quality stocks, which I won't touch. And a little bit different. I do like trading. So just technical side. And then I have sort of like small caps as well, which don't really fit in. And I don't like trading small caps. That's what I've discovered. So originally I just wanted to have 2 portfolios. So high quality and trading, and I put small caps in trading. But then I realized I just don't like trading small caps because they can be quite volatile. That's what I've realized. They can be highly volatile. So, and when it comes to small caps, I'm looking for companies that are very close to inflection point or have hit the inflection point and are going to grow. And I think the reason I want to do that is those are sort of companies that can make significant gains over a short period of time, even like a 1 or 3 years. They could be up 500% in that sort of time period. So on to the first bit. Can you address any particular light bulb moment? That's easy. Back in 2013, unfortunately I can't show you the chart because it's M2 Communications. Ticker used to be MTU, MT Communications, ticker code MT, was it MTU? MTU, yeah. I don't think chart 2010 to 2015. I'm just trying to think if I could, there's a chart anywhere I could find. Share price chart. They were bought, I forget who they were bought out by. I wonder if it's going to work. This is Investing Australia. The problem is I don't know what day it was. I just don't know what day it was. This must have been when you can download this, but I want a chart. Whoops, wrong copy. Just going to ask this. I don't think ChatGPT will help me here. I'm very doubtful. Oh, hello. Maybe it does. Maybe it will. Yeah, merge with focus. That's right. 2016. Okay, so it's not going back further enough. Or maybe it was. Maybe it was this. So it looks maybe it was right here in August 2014. That might make sense. What I do remember with M2 Group or M2 Communications was the share price was going sideways, just going sideways. I'd been reading a lot about technical analysis, just reading books, and I didn't understand M2 Communications because the P ratio of the company was like 12, 13, which was really low for telecommunications at that point in time. Share price going sideways, and all of a sudden, share price popped up. It must have been on full year results. If it was August 2014, it must have been on full year results because I remember what happened. There was not a lot of volume, and all of a sudden, there was a share price increase on higher volume than usual. And I went, oh, this is like a breakout. And you can see what happened to share price after that. So share price on the breakout was around about $6. And over the next year, the share price, less than a year, the share price went from $6 to $10. The share price did nothing for a long period of time. That's the light bulb moment for me when it comes to technical analysis. That was it. That's when I realized there's something to it. And that's why I always talk about breakouts, because it's this. It's M2 Communications or MTU, whatever they're called now. Well, not called, but because they'll merge or whatever. I just wish there was a chart. So thank you, ChatGPT, for giving me a little chart. I wish there was a longer chart than that. Anyway, so And that was the light bulb moment for me. The other one here is you mentioned or any change in how you find quality stocks or any change in view of the stock market investing career. So how you find quality stocks. For the longest time, I did not understand return on equity. For the longest time, I didn't understand it. I did not understand how important it was. Not only return on equity, return invested capital, those sort of things. And then I started thinking about it. And then one day I just went, oh. So I have this example of return on equity. I won't say it right now. It's a little bit too long. But that was another light bulb moment when I realized how important return on equity or return on invested capital are for the long-term growth in a company. Anyway, so thank you for that question, Fishball. Adrian says, hi, Kneppy. A Chinese view on Megaport would be great. Seems to be breaking out. Ooh, we have a few breakout questions here. So let's have a look at MP1. Megaport, highly volatile, this one. Ooh, this chart actually does look good. I do like this chart, but the problem is with Megaport, the chart looks good all the time, then looks bad, then looks good, then looks bad. And when this company releases any sort of results, the market just either panics or complete opposite. So the chart actually does look good for Megaport. I do like this chart for Megaport. So we do have the higher high, higher low, that sort of thing. Oh, I hear a plane. So yeah, I wouldn't necessarily say this is a breakout by my definition, because typically what I look for in a breakout is a share price not doing much, maybe even going down a little bit or sideways, and then the share price jumps up on high volume and on good results or good financial numbers or good announcement. So here what I see is the sentiment in the company has shifted from negative to positive, and we have seen an uptrend develop over the last 3 or 4, 5 months. So I just see an uptrend here developing. I probably wouldn't buy this just yet. If I really wanted some shares, I'd probably wait for a dip back towards $11 if it happens. Stu Percy, talking about breakout. Thoughts on NextDC? Looks like a breakout. Your new camera makes your hair look healthy. What is he saying? My hair didn't look healthy before? Now, I am getting older, and as we age, our hair becomes a bit of a issue. NextDC. I am a shareholder of NextDC. This is another long-term hold for me. I wouldn't necessarily classify this as high quality, but it's just in a really interesting space. For me, yeah, this wouldn't be necessarily a breakout. I wouldn't call this a breakout. So again, as I said before, my perfect breakout will be the share price of a company going sideways, or maybe even going down a little bit, and then share price popping up on high volume on some good results or good news. And we don't really say that with the NextDC. I just think there's been a shift in sentiment when it comes to data centers. That sentiment was really negative for a period of time, for about 3 or 4 months, maybe even 5 months. That's why the share price of NextDC just dropped like a rock. And I think that sentiment is starting to shift. And for a really good example of a breakout, and I looked at this the other day, 360, Life 360, not what's happening now, but if you go back, this is what I like. This is the sort of thing I look for. Share price not doing much between August 2023 and February 2024. And then all of a sudden, the company released a really good announcement. Share price popped up 38.5% on that day. You could have bought shares at $11, and share price has gone from $11 to $30 in just over 1 year. So I was in this trade, I got out, and I probably shouldn't have got out. That's okay. This was just a trade for me. And I took profits. And I also added to that position. And I can almost guarantee you, on this day, when the share price rose 38.48%, there would be some experts out there who said, you're too late, you've missed the boat, you have to be in it before. That's bull-wacky, that's BS. That's BS. History shows in these sort of events, there's a good chance, not a 100% chance, but a good chance the share price will go up. Again, it's not a 100% chance, but there is a good chance. I'd say maybe 60 to 70% chance the share price will go up in a beautiful uptrend. Anyway, I don't think NextDC is that for me. Trader Hooper says, thanks, Kneppy. I'm happy for you to bank some videos and release them while you are away if you're watching the market while you're gone, I'd love a short, say 20-minute video whenever it suits and whenever you've got something to say, just chatting about some stocks or other market information that has caught your eye. However, it is important that you enjoy your holiday, so do what suits you. Just my thoughts. 3 thumbs up, so I thought I'd talk about this. I have no idea what I'm going to be doing yet. So I've already mentioned that by the evening over there should be the morning here. In fact, so I'll be mostly in the Western time zone. So for instance, 8, so we'll say 6 p.m. 6 p.m. Seattle. Why not Seattle? Time in Brisbane. Why not Brisbane? So it'll be like 11 a.m. So the market is just open. So it looks like the market will be opening like at 5 p.m. or something. Now, this could be changing because of daylight savings, and I don't know. But it looks like the market will be just opening as I probably get home from my hike. So if I do a video, it will be released in the morning here, because in the evening here, or afternoon evening, I'll probably be asleep. So yeah, so at say 4 p.m., 5 p.m. here, it'll be like just after midnight. So yes, I won't be doing that. So I haven't thought what I'll be doing just yet. Haven't thought how I'll record the videos because I'm not taking my iMacs, not taking my video equipment, that sort of thing. So I could just do a live video. Not sure yet. Reptilian, step 1, increase its advertising again. Too expensive. Other company is noting that. I've noticed an increase in advertising for step 1 because I am a customer of step 1. I do get a lot of stuff from step 1. I tried to buy some more underwear from step 1. It's not really the underwear I like. It's the, what do you call it? I run in them. I'm not sure what they call them. So traditionally I've bought these, what do you call them? I forget what you call them. It's these not running shorts, but I forget what they call them. But they would cost like $100 each. And step 1, you pay $10 to $15, if maybe even less, if you buy on a bulk, which I do with step 1. I just buy on bulk and get lots of savings. So sometimes they come up with these deals where you buy 5 and then you get 5 free, or buy 10, get 10 free. And that's what I do. Anyway, Reptilian also says, I buy Hello from Temu, 10 pairs for under $20. It's like $2 a pair. What's the quality? What's the quality? I have no idea what Hello is. Let's just see if this works. 10. Yeah, what's the quality? Well, the quality of step 1 is really good. So I'm really impressed with the quality of step 1. So I'm not sure the quality of this. So Reptilian, just leave us your thoughts on the quality of Hello. And probably more important is there a range of different type of underwear? So yeah, step 1 have a sport underwear. So let's have a look at step 1. They have a sport underwear. What's it called again? I forget. Men. Cloud Mesh Sport. That's the one I like. And sometimes they do have these deals. So it says 37 each, but they do have deals on occasion. And when they have deals, that's when I buy on bulk. But I want to know the quality of these underwear that you're getting $2 a pop. That's, anyway. Paul on Mail also has a suggestion. Perhaps you should do a weekly summary like Jason McIntosh. Ooh, okay. Back to this. Where is it? Back to VB Ed, Livewire videos, or what videos, YouTube videos I watch. And with this particular comment, Jason McIntosh, I watch his videos every single week. So I watch Jason McIntosh, his videos every single week. So his technical analysis Motion Trader. So I watch his videos every single week. So he has 2. So he has one on his Motion Trader website, but he also does one on self-wealth. And the other one I do is Carl Lingua. Now I get his videos via email. So technically I don't watch them on YouTube, but that's how you do watch them on YouTube. But I get the link via his emails. So I'm not even sure if he puts them on. Yeah, he does. So I watch these live market. No, that's not what I watch. Yeah, that's what I watch, the live market analysis. So these can be fairly long, fairly evolved. For instance, he talks about, he just looks at charts. That's all he does. So that's a pretty good one. So thank you for that comment, because the light bulb just popped up and I realized, yeah, I do watch other videos as well. So weekly summary, like Jason McIntosh, do enjoy your daily summary. And VB there you go. VB says, I agree with your suggestion. A weekly video will suffice. I'm on holidays and shouldn't feel obligated to do videos. Yes, thank you. So thank you for that suggestion, and thank you for don't know how you did it, but you reached into my mind and pulled out some other thoughts, other suggestions. Scott says, Smart Group's AGM material is probably better than I was anticipating, but more so, management seems to be ticking boxes, reaching milestones, and I like to hustle. Maybe one that's flying under the radar a little bit. This is one where I think, and I could argue, it's looking good value or even cheap. The chart has not been looking good, but is the chart turning around? No, it's not. Not turning around. There was a little bit of a potential breakout back in February, but that fell apart fairly quickly. But this was looking expensive not that long ago, and I think it's looking okay value. P ratio 13.15, dividend yield 6.36. So this is definitely on my watch list just because of valuation. But if you have a look at the long-term chart, share price has done nothing over the last 6-7 years. After beautiful rally in the share price from when they listed to 2018, share price went from $1.50 to $13. Gee, that's a nice little return. So thank you for that, Scott. And the other one was Macmillan Shakespeare. That popped up on my radar. Another one, SG Fleet's been bought out. And there's also FPR Partners or something. Fantastico. Was it Core Lithium that previously said lithium demand won't be in favor until 2029, or Lake Resources? It was Lake Resources. It was Lake Resources who said that. It's good that you remembered. I remember going through Lake Resources, one of their announcements. I could be wrong here, by the way. I'm pretty sure it was Lake Resources. And I'm trying to remember how long ago it was. Was it the 17th of March? It seems like it was longer than that ago. I'm just going to go back 1 year. Could have been the AGM presentation. Was it like in November? And the main thing was Lake Resources says, well, there's going to be a glut of lithium supply until around the time they start production. And I thought that was interesting. Yeah, lithium market outlook. Yeah, market undersupply forecast in the next 5 to 7 years. Oh, they got 2030 yet. Lengthy lead times to develop new projects indicate lithium raw material deficits could emerge beginning in 2030 and extend to something by 2035. So they're saying we're going to see a supply deficit in 2030. Yeah, so it was Lake Resources. VBN says, good day, Kneppy. Please share your thoughts on the RBA likely to drop its interest rates on Thursday or Tuesday. Which stocks do you anticipate will surge up the most? Consumer discretionary stocks, the REITs, the property developer stocks? I think none. And the reason I think is because it's already been priced in. I think the market is already pricing in an interest rate drop. If it's more than expected, that's when you might see rallies in some of these companies, particularly the REITs, property stocks, consumer discretionary stocks as well. But if there's not an interest rate drop, I think there's a small chance, a very small chance, then we're going to see a bit of weakness in some of these companies. And the very fact that because we saw some interesting news flow in the last week, wages, and also, what's the other one? Wages and labour market. So just labour market itself, I think there is a chance that we won't see as many interest rates decreases, and that will affect some of these sectors. So anyway, so I don't think there's going to be any significant rally in share prices because it's already priced in. Everyone is expecting it. PTV Fund says, what is going on with Meeka, in your opinion? Not in production yet. So gold uptick didn't really have an effect, and now it's edging down. Well, it's just gold. It's just gold prices. The main effect on Meeka metals is more than likely or primarily gold. So let's just have a look. In fact, what you can do is if you add gold, and put it as a line, you can see a pretty good correlation between the two. So in blue is Meeka Metals and gold is in purple. In fact, Meeka Metals has done even a better job than gold. And we have seen both gold and Meeka Metals drop over the last week or so. Now, if gold continues to drop, I would say Meeka Metals probably would drop at an even greater rate, maybe. But it seems like it had been increasing at the same rate as gold from January. So again, Meeka Metals is highly dependent on gold prices. So I think that's probably the answer. There's nothing else, I think. Yep. Trader Hooper says, in your banked videos, we could give you some companies to examine and you could give your opinion on whether you think they are good quality. Might be good trade or an avoid. We should be able to anticipate your response, but it could be interesting to see what points you raise that we might have overlooked. Just a thought. That's a good suggestion. I would consider this. Yeah, and this is all based off my own thoughts. Whether a company you mentioned is good quality by my definitions. And hopefully you have your own definitions and you could have different opinions than mine. And even a good trade, different opinions or avoid. It's all based on me because I cannot give advice. It's all based off my own opinion and what I would do personally. Jack Chard says, hi, Kneppy, please do a video of TWE Treasury Wine's a high-quality company. People often call it a high-quality company. Lots of research companies give it a buy recommendation. Jake Chard. You know what? I'm going to do a standalone video on this, I've decided. I'm going to do a standalone video on Treasury Wines because where the share price is right now is at an interesting level. And if it is a high-quality company, big if it is a high-quality company, you get a two-banger. You get a possible nice little trade, plus there could be some good value here, maybe. By the way, some big volume coming in the last 2 days when the share price gets very close to the support level. That's interesting in itself. The big volume coming through. Someone knows that's a support level. Okay, so standalone video on Treasury Wines. What else do we have here? Oh, VBEd says, 1 month ago, Bright Star Resources was only 2 cents per share. The company did a 1 for 25 share reconstruction. I suppose that's a consolidation. And this has resulted in a big increase in share value for shareholders. I'm a shareholder. So is this a little bit different than a consolidation? Because you're saying here, big increase in share value. Has the share price just gone up, or has the value of the shares, your shares, gone up in value? A little bit confused there. I am a shareholder. In regards to NRW Holdings, do you remember some time back when there was a Trinker event after? Yes, I do remember that. After the CFO son resigned, it is logical to assume that he walked out over this 112 million that Waialae Ports owes the company. NRH thought they had security over Waialae Ports assets, but they don't. That is a good good assumption, maybe. I think that's a good assumption. So it was it this day here, the 13th of January, share price was in an uptrend and suddenly share price dropped 9.45%. So 30th of January, let's just confirm that. NWH. I get the ticker codes mixed up all the time. Was it 13th of January? CFO just suddenly resigned. 13th of January. Yep, CFO resigned 13th of January. And that was a trend killer event. Look what happened. And I thought at that time, maybe the market's overreacting, but I did sell because I was trading the company at that point, but I did sell because of my rules now. And yeah, look at what happened to the share price after that. I do like how the market reacted on this news the other day. Really, a lot of buying came in. Not as much buying yesterday, but interesting how the market did react to that. But I wouldn't be surprised if that's what happened. If the CFO just went, meh. By the way, I do know someone, personally know, well, not personally, I sort of know someone who was the incumbent CEO of a company. And then he suddenly left. And I was like, ooh, by the way, this was not a good company. It was called PAS Group, if I remember correctly. PAS Group, PGR, T code. Anyway, he suddenly left, and I was like, does that mean anything? And the company went into administration a few months later. So you read between the lines. He's obviously thought, well, there's not much future in this company. There's no point me being the CEO because this company is going to go into administration. So sometimes they probably do know something bad is going to happen. And they're probably thinking, now's the time to get out. I'd like more information on this share reconstruction, how it increased your share value. Spuddy says, quick question on pre-market bids. I read the GrainCorp announcement as soon as released. I clicked on the stock details and bids in excess of $7.50 had already been placed. Approximately 10,000 stocks were being sold for under $7. I considered putting in a cheeky bid of $8 just before market open. However, I'm cynical and convinced myself that a bot would outbid me and I'd be left overpaying for the stock. What are your thoughts on pre-market bidding in situations like this? Do you dabble or do you wait for a pullback in the stock before buying? So a lot of time, yeah, I've done this on a few times, and what I typically do is I put in a price I'd be willing to pay. And a lot of times the price I'm willing to pay is a breakout level. So if the share price might be going up 10% and it's the breakout level is say $7, and I think if it gets to $7.10, that's a good breakout level. I'd put the bid in at that level, but if the share price doesn't get up to that level, then the problem is it's not a breakout and you're buying in on a lack of a breakout. So that is a problem. So sometimes you just have to trust that it is going to break out. So you're putting a lot of, and sometimes you just don't know what the share price is going to do. Sometimes you just have no idea how much bidding is going to come in. And a lot of times you will see a little bit of selling, but sometimes the share price will take off during the rest of the day. So I have seen occasions where the share price takes off during the rest of the day, and that is actually a breakout. For instance, as I was talking about Life 360, so actually this is a pretty good example. So the share price, they released something pretty good. Share price opened at 950 and just rose all through the day and closed at about 1150 or just below 1150. And I bought during that day. I didn't buy on open, but I bought, I think it was about $10 or maybe $10.50. I forget exactly what. But I was willing to buy shares on that day. But that's what can happen. In fact, that is a true breakout. Now, a lot of times I'll just wait a few days just to see what happens days after. And if I don't see a lot of selling, you don't see that with Life 360. A few days after that day, there wasn't any selling. The reason I know there wasn't any selling, well, there was selling because if there's buying, there's selling. But what I mean of no selling is we don't see any sellers put their bid in at market. And if they put the bid in market, the share price will drop. And if we see overwhelming enthusiasm from the sellers, the share price will drop. We don't see that here. So that means this announcement was powerful. So sometimes we'll wait a few days, but sometimes I will just know it's going to be a really good announcement. Market's going to like it, and the share price will pop up like this. GrainCorp, can't remember what happened, but it was a nice little announcement. Where are we? There we are. And there wasn't much. Share price sort of opened. What did it open at? It opened at 765, went to a high of 781, low of 755, then closed at 778. So there wasn't much range in the trading on that day. And I do like this chart. I do like this chart for Graincorp, by the way. Just the valuation of the company, I'm just unsure about. So very rarely, sometimes I do, but rarely do I do that sort of thing in pre-bidding, because you just see so much manipulation going on. Bids pulled and put back in, pulled and pulled back in. People are trying to manipulate where the share price opens up at. I just don't like it. Fantastico says, this is going to be a standalone video too. If you held CSL for the past 5 years, you're down 20%, but CBA up almost 20% or 200% through the same period. And then Scott, I mentioned, but if you bought CSL 250 and sold at 300, so it just says it's trading it. So what Fantastico is saying is, because of this is what happens in the past, we're going to see this in the future. I'm just saying that in jest. So this is really interesting. So what I'm going to show you now is what happened between of CSL, what happened of these two companies between 2015 and 2020. But Fantastico is right. In the last 5 years, we have not seen either company. No, we have not seen CSL give a good return. But let's have a look. So if we have a look at CBA, and what I'm going to do is just have a look at share price. And what I'm doing here is, in the last 5 years, it's really convenient because this is the last 5 years, a 23.6% return in the last 5 years just based off share price. But in the same period, the earnings per share has grown 1.1%. So what is that telling you? Share price has increased 23.6%, but the earnings per share has grown at 1.1%. Now, I am discounting dividend yield, but that is telling me that the market is paying a more and more premium from CBA, but there's just no growth. There's just no growth with CBA. It just doesn't make sense. So is that going to continue over the next 5 years? I'd say the chance of that continuing, of you getting a 23.6% return just in the share price, I would say the probability of that happening is probably less than 1%. I'm going to say that it's probably less than 1%. Okay, so what I'm going to do now is have a look at the previous 5 years, and you can actually do this in FinChat. All you have to do is just move this to there. And from 2015 to 2020, CBA had a return, just the share price, of negative 6.4%. And the reason that's important is, if you go back to 2015, was the last time CBA was this expensive. And when I say this expensive, I don't mean this expensive. CBA is actually way more expensive than it was in 2015. And this is a sort of return you got in CBA over that 5-year period when it was really expensive. You got a negative return. And I think that's a really good chance of CBA in the next 5 years. You're going to get a negative return because of what we have seen happen in the last 5 years. Now, let's have a look at CSL. And the last 5 years, CSL has given us a negative return, just the share price, negative 4.6%. But if we go back between 2015 and 2020, it was 28.6%. So you can see what happened. So you just can't look at a 5-year period and extrapolate that moving forward. And why this is interesting when it comes to CSL is, what do you think is more likely going to happen in the next 5 years? Will CSL have a return of negative 4.5% when it comes to share price? Or will CBA have a return of 23%? Which is more likely? Which is more likely? CBA having their return, or how can I frame this? Because I think neither is that likely. What is more likely? CBA having a return of 23% in the next year, or negative 4%, or CSL having a return of, I don't know. How do you frame this question? What is more likely to happen? CBA, Commonwealth Bank, having a return of 23%, and CSL having a negative return in the next 5 years, or this being flipped, where CSL has a return of 23% and CBA has a negative return. Which is more likely in the next 5 years? And I can almost guarantee you that I'd put all my money, every single cent, in CSL having a really good return over the next 20 years, next 5 years, and CBA having a negative return in the next 5 years, just because of what we've seen in the last 5 years. And I've changed my thinking. I've looked at returns of companies over a certain period, particularly when it comes to high quality companies. And I thought, oh, 23% return over the last 10 years, that's really good. And what I've realized is that when a high quality company has a pretty bad return over a given period of time, like the last 5 years, that means a company is way more attractive. CSL is becoming way more attractive right now because we've seen a period where or the company's gone through a period of multiple contraction. The market is less and less willing to pay premium for this company, and it's got to the point where the P ratio of CSL is below that of CBA, which has never happened before. It's never happened before. Typically, CSL has a P ratio that is more than double that of CBA. So again, just based off that information, I think over the next 5 years, CSL is going to absolutely destroy CBA when it comes to returns. So that's one of the dangers of looking at the last 5 years or last year and just extrapolating that number. So hopefully I've been clear with that. I would put all my money, if I was a betting man, I'd put all my money that CSL in the next 5 years would destroy CBA returns. Okay, so, this is a good little comment from Ben Hutchinson. And the reason it's a good comment because I'm always looking for counter examples, I suppose you can say, because that's what Ben Hutchinson described it as. So my trend killer theory you've mentioned recently, it does make sense, but I do have a possible counterexample to consider. Audinate. Audinate released a good update and are up about 25% in the day. However, despite this, the downtrend reasserted. They fell back almost 50% into April 7 lows. Now in May, they have appeared to be recovering. So maybe the April bear market, especially for tech, just overrode the usual trend killer technical pattern. Myself, I've been loading up on Audinate in these lows. I'm more value than trend style investor, and I think I'll not regret getting Audinate for $6 something in years to come. So I am a share of Audinate, and I actually do remember this little possible trend killer event, and I did not buy in. I thought, no, here it is. So the 17th of February, I just went, no, I do hold some shares. And interesting enough, below $6, I am interested, but I did not buy any shares. So it has had a nice little rebound over the last few days. But what I'm going to do with Audinate, and this is what I've decided, is I'm just going to wait for a bit of a shift in sentiment. I haven't really seen it just yet. It looked possible then, and that was a possible trend killer event, but it was destroyed by the tariffs. But all I need is see a little bit of a change in sentiment, and I will add to my position in Audinate. So I am looking for these counter examples. So I'm going to put this into my trend killer watch lists. I'm adding to that every single day, it seems like. And there's quite a few replies here. Scott says, be wary thinking that when a stock goes from $8 to $4, it is therefore better value. I'll suggest the stock can go from 4 to 8 and offer better value. That's true in a way, but Audinate is the sort of company that has a really good moat. It's going to grow significantly over the next 5 years. So I think the little bit of negative sentiment in this company is just because their results, or it's because of an oversupply. A lot of companies were oversupplied with their products or their products, and that has been gone through. Anyway, Ben Hutchinson says, well, way market's going, Audinate may well go 4 to 8 or very soon. So I guess it becomes a good value for you. But if so, I'm sitting on 30%, 5% gain. Okay, and there's a lot of toing and froing here. Oh, so Scott says Clearway has a possible lower growth rate but a wider moat. I'd say Audinate has one of the highest or widest moats in Australia. Their competitors are just going down. Their competitors are just going backwards. So I would say Audinate has a really good moat. Anyway, so thank you for all those comments. Scott says, I can't help but feel there's a bit of value in Sonic Healthcare. Quite offensive stock, yet with growth potential under the hood. I hope it stops dragging its heel soon and changes gears to the upside. I don't suppose you're familiar with NSB. Is that neuroscience biopharmaceuticals or something? Neuroscientific biopharmaceuticals. I was on the right path. So let's have a look at Sonic Healthcare. I'm just going to have a look at, this is a company where I would oscillate between thinking this company was high quality or not. I'd probably say this is, when you look at the quality spectrum, it's sort of in the middle, close to being high quality, but sometimes I think maybe not. So that's Sonic Healthcare. In the chart, it does nothing for me. And because I'm just not sure about the quality status of Sonic Healthcare, I'm more likely just to trade it. I think I have traded in the past. If you have a look at the weekly chart, share price was in a beautiful uptrend from 2012 through to 2021, but then because of COVID-19, and they were the beneficiaries of COVID-19, but then those benefits came to an end. And just based off the weekly chart, the share price actually has been in a downtrend for a while, but who knows, maybe the downtrend is coming to an end soon. I don't know about the valuation of Sonic Healthcare, 23, dividend yield 4%. So anyway, Neuroscientific biopharmaceuticals. I don't know anything about this company except I botch their name. Close, but still botch their name. And they did release something. They released something on the 16th of April. Share price up 49%, but I don't like that candlestick. So that's telling me a bit of selling came in. So it wasn't as powerful as what you might hope for. And what date was that? That was 16th of April. 16th of April. Neuroscientific to acquire leading stem cell technology. I don't think I actually looked at this. I might have quickly looked at it, but I can't remember looking at it at all. I think the big question is when would any sort of revenue come in? Talking about phase 2 trials, that sort of thing. So still a long way from me even thinking about investing in this company, just because it's too much of a story stock, I'm assuming. And we can have a look at the pennies 4C. I'm assuming they don't sell anything, more of a story stock. Yeah, so too much of a story stock for me at this point in time. Oh, the last question. Oh, finally got to the last question. Or not even 1.5 hours. Where can a graph, how do we say graph? When can a graph of a market cap over time be found? I have found when companies do a lot of capital raising, share price over time can give a misleading impression on the company's value. That's absolutely true. Ben Hutchinson also says, true. Don't know. Actually, I tried getting FinChat to graph it, but it wasn't successful. Actually, I prefer EV to markup since it's just for company debt. I think on my wish list would be a graph of revenue share. Hey, you're thinking just like me, Ben. So I do prefer EV to markup, and I do prefer revenue per share. That could be help understanding roll-up companies that grow revenue by acquisition, but do so many capital raises to fund it. So that's exactly why I prefer revenue per share, because it gets rid of these roll-up companies that are acquiring, they're growing a revenue, but the shares on issue keep on increasing. So it's exactly why I prefer revenue per share. So we have earnings per share. Why not can we have revenue per share? Earnings per share, revenue per share. Please. Now, to the question, markup over time. I've done this once before. And I'm trying to remember how I did it. And I have a feeling it was TradingView. And I have a feeling so I don't, you can't get, I suppose you could get candlesticks, but oh, wait, where is it? Oh, it's down there. Oh, I don't know how to use this. Market cap. Simple. Well, this is probably the most popular one. See if this works. Where is it? Let's go to a bigger company. Let's go to CBA. Why not? Where's my market cap line? Market. No idea. No idea. I have looked at this in the past where I did want to see what a market cap chart might look like. And because, yeah, capital raisings can really distort what's really happening with the company. And a great example of this was Tesserent. I do quite a few videos on Tesserent because they were acquiring a lot of companies, building up their share bases. Their revenue was going through the roof, but all these acquisitions weren't beneficial for the shareholder because the share price wasn't doing anything. In fact, it might have been going backwards. So you have to take into account shares on issue and how dilutive capital raisings are. And that's why I do prefer revenue per share over just revenue, because you take into account dilution. Anyway, so that's one of the reasons why I did actually like Guru Focus, because they did look at revenue per share. FinChat doesn't do that. They just look at revenue. They do look at earnings per share, but I do like revenue per share. Okay, so if anyone can find maybe in TradingView how you can just put in the market cap of a company, I would love that. I am for certain, I had been looking at market cap favorites. I wonder if I put it in here. This was quite a few years ago, but I'm pretty sure I was looking at market cap, just a market cap chart, and there's a chance that maybe it's whoever did it. Was it simple as that? I suppose you can, yeah, you can put it in the lower, in a different, whatever you call these, panel. You can put it in a different panel. What's a company that's been highly acquisitive, as significant increase in shares? I can't remember, but I suppose you could do that. I just want to know if you can put it into, there we go. There you go. See what I did then? So I took it from that panel and just put it into this panel. And there you go. That is a market cap. Oh, it doesn't go far back though. What's a company that has been highly dilutive? Peninsula. For some reason, it just came up with Peninsula. Let's see if this works. In fact, you can sort of see this in this little chart going back to 2017, because the market cap of this company was really low. It's like $100 million, and the share price was like $4 or $5. And all of a sudden, the market cap went above the share price line, and now it's well above the share price line. So the market cap of this company is 120 million. Share price is like 50 cents. So share price is significantly lower than it was back in 2018, but the market cap is actually higher because of the dilution. Okay, so that's all I have for this answer and reply video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.